What's going on, guys? My name is Mark Palomba. I'm one of the top traders with Day Trade Today. I've been trading for about 15 years, about 10 of it as a professional trader. Started off as a prop trader, actually moved into kind of retirement planning, financial advising, became regional vice president of a financial advising company, and now I currently own and run my own hedge fund focused in digital assets. So in my experience of trading, I've kind of dabbled in a little bit of everything. I started off originally as a scalper. Originally I started off with penny stocks. Then I moved into scalping. I was trading about 500,000 shares a day in Bank of America. Then I started moving into more of momentum and trend trading. Got a bit into swing trading. Then now I would say, I did a lot of options trading, dabbled in algo trading as well. I would say right now my strategy mainly consists of a blend between momentum and trend scalping and momentum swing. So one question I get a lot is, what is a cryptocurrency? And kind of to start that question off, you really kind of need to look at what the first one really was. And it was basically Bitcoin. So Bitcoin was created in 2008 after the financial crisis, where basically the government was just printing money and devaluing the US dollar. There was a lot of lack of trust that happened in the banking system, and just bailouts. They just got bailed out for everything that they did. So what they ended up doing is they basically created Bitcoin as a store of value that could never be altered, changed. At the same time, you didn't need a middleman to be able to transact with somebody. So you can transact with somebody anywhere across the world, and there would actually be a transaction log, and you can trace that all the way back from the creation of that Bitcoin. There's a limited number of Bitcoins that are out there, and so there's a natural scarcity to that. So with that, granted, it goes into a lot more detail and a lot more complications, but Bitcoin is this digital gold in a way. So this digital gold can be transacted with anywhere and anyone in the world, and it's actually divisible up to 8 decimal places. So you can transact with 10 cents, 20 cents worth of Bitcoin. You don't have to buy a full Bitcoin. But that basically created a whole new digital asset class now, that you can transfer asset and wealth between two parties anywhere in the world, not needing intermediaries and a bunch of banks cutting into fees. One of the most important and biggest influences that cryptocurrency and digital assets has had is in the space of decentralized finance. So what that means, one of the reasons that cryptocurrency is so valuable is the fact that it's not centralized, or most of them are not centralized in any one location or any one person having control over it. No one government, no one direct investor, individual. So it's an open source and basically money for the people, peer, right? Well, then they end up creating something called decentralized finance, which is basically mimicking all of the bank features and bank tasks and things banks do, but now crowdfunded and all based off of a trust network that's built off of cryptocurrency. One of the things, if you look at a bank, you put your money in a bank. You say you had $100,000 and you put $100,000 into the bank, right? They're maybe going to give you, if you're lucky now, less than 1% interest. Do you know what they're doing with your money though? They're lending it out. They're giving your $100,000 to somebody that's going to be a loan, mortgage, sometimes credit cards. They're using your money that you're putting in there for storing, and they're charging people 8% interest, 10% interest, 15% interest. And so they're basically, what's costing them less than 1%, they're making 10% plus off of your money. And so now what decentralized finance has done is actually made it in areas where you can actually lend and borrow money. But at this point, I can lend out Bitcoin right now and make 8% interest off that annually under a trust network of decentralized finance. So it's now created a whole new asset class that now is changing the way how we do finance. So shortly after the creation of Bitcoin, next came Ethereum. And Ethereum, what it ended up doing is basically it was the first smart contract. So what they did is they built an actual programming language on top of the blockchain that now not only can you transact with somebody, but it also can keep conditions on that contract as well. So almost actually acts as an escrow as well. So this basically allows people to transact and create multiple different use cases for each individual new coin that now allows for a trust network between two parties that don't need anybody. So with the creation of Ethereum, you now have a whole new wave of use cases on how this technology and blockchain technology can be used to change things and just benefit the world, cut out middlemen, and make things more efficient. Not to mention cutting out a lot of fraud that exists already. Moving into other types of cryptocurrencies, there's now parts where if it's expanded into real estate, it's expanded into finance, it's expanded into multiple different areas. There's certain types of coins that are meant to act like a dollar, that actually mimic the dollar. There's actually other coins that are in par with gold. There's other tokens that are actually privacy coins that basically you can move and transfer wealth without people necessarily knowing. So there's a lot of versatility to what cryptocurrencies now created in this whole new digital asset class. So in my experience of trading, I've kind of dabbled in a little bit of everything. I started off originally as a scalper. Originally I started off with penny stocks. Then I moved into scalping. I was trading about 500,000 shares a day in Bank of America. Then I started moving into more of momentum and trend trading. Got a bit into swing trading. Then now I would say, I did a lot of options trading, dabbled in algo trading as well. I would say right now my strategy mainly consists of a blend between momentum and trend scalping and momentum swing. So what is momentum trading? So momentum trading is basically trading in the direction of the trend. And so the trend can be as not only what the general market's doing, but also what each individual coin is doing. So me personally, I always trade, so we're talking about stocks, I always trade in the direction of the SPY. If the SPY is going up, I'm looking for stocks that are going up. If the SPY is going down, I'm looking for stocks that are going down. I never want to go against the market. And granted, there's a lot of opportunities that are there, but at the same time, I never want to swim upstream. You always want to take the path of least resistance. If I'm going in the direction of a trend, it's trending up. If I get a bad entry, all I have to do is wait, and the trend will always be there as support. So it'll naturally be pushing the market up with it. So what momentum trading is doing is you're basically always trading in the direction of the trend, and ideally, even higher highs make higher highs, and break of higher highs end up creating new higher highs. And so creating that momentum that you're now catching that wave all the way up until it changes. One of the biggest questions I ask is, what are the biggest do's and don'ts of trading crypto? So one thing you have to understand about cryptocurrency is, since it's not centralized in any one location, it's not just happening here in the United States. This is happening all over the world. So it's trading in Japan, it's trading in Europe, it's trading in South America. And so because of that, it's open 24 hours a day. So the exchange never closes. And that has its benefits, but it also has its cons. One of the benefits is price movements when you're talking about the stock market. So 80 to 90% of stock movement prices happen overnight in pre-market or post-market. There is no pre or post-market in crypto. So you never really have those big gaps. One way that benefits is you never have to worry about your stop or stop loss getting skipped over, right? And so because of that, it actually can be a bit safer if you trade it the right way. One thing about crypto is it's not just because it's trading 24/7 doesn't mean it's always moving. And so one of the biggest do's and don'ts, I would say, is don't overtrade. There's wait for the bigger moves and stop focusing on the smaller moves. With crypto has the tendency to have a much bigger follow through where you end up seeing, a 10, 20% move in a day is very common in crypto. Not to mention 100% move in crypto is still just as common. So when you end up having breakouts, you don't really have to, there's a lot more follow through on those, right? And so one of the things I end up doing is I trade the 4-hour chart. And so with that, I'm not so focused on the little movements, but more so the big movements. And one of the best things about that is since you're trading a 4-hour chart, you're able to see things coming ahead of time. And so you can actually trade crypto very, very well when you have a full-time job. You don't have to worry about that sprint from 9:30 to 11 or from 2:30 to 4, right? So you have a lot more flexibility, especially when you're talking about now more swing trading in crypto. One of the biggest things not to do in crypto is, since there's no real broker, you're dealing directly with the exchange. So there's a lot of exchanges that end up offering you a lot of leverage, 100 times leverage. And for the people that don't know what that means for $100, I can basically buy $10,000 worth of Bitcoin. But if that Bitcoin price drops more than what my balance would be, $100, I lose everything. So a lot of times you'll find crypto traders end up getting too excited and they'll end up putting in way too much money, becoming way over leveraged, and then liquidating, losing everything, okay? So that's the biggest thing I would say. Secondly is since you're talking about crypto and these digital assets, you have a wallet. Everyone has a specific wallet that you create and that has a specific wallet address. So keeping that in a safe place, those keys, is super important. And that's probably one of the biggest mistakes some people do, is they might actually lose that key, in which case if you do, it's basically like you lost bearer bonds. You basically lose your money. There's no way to access it, right? So it's super important when you create a wallet or you create a new account that you back up everything. So probably one of the biggest questions I get is, how do you trade cryptocurrencies? And there's a bit of a learning barrier with this. It's a little bit different as far as getting into it than some other stocks and Forex and stuff like that. And that's because you don't go through a broker. You go directly through the exchange. And so typically when you're trading stocks or trading Forex, there's always a middleman, right? And so there's a middleman that's your broker. That's going to be connecting you to the exchange. So with cryptocurrency, you actually can choose which exchange you want to trade on, depending on what you're looking to buy, and actually purchase it. But as far as actually trading it, it trades no different than a stock would. I trade cryptocurrency the same way I traded stocks, I traded commodities, I traded options, and I trade Forex. It's the exact same. You're still talking about a bid and an ask, buyers and sellers, right? So as far as how do you get into trading cryptocurrency? So the main two, I would say, biggest exchanges that were best for people starting off would be Binance/Binance.us, depending on where you live, or Coinbase. And Coinbase is a very heavy US-based exchange, and they're actually probably one of the largest in the United States, where Binance is one of the largest in the world. Granted, there's a couple other exchanges you can do for more advanced traders, some like Deribit, which is more international, but that offer you up to 100 times leverage. And on top of that, even offers you options on Bitcoin and options on Ethereum. And so there's a lot of new tools that have been added towards trading in this area, and the space has grown immensely in the past 2 years, and it's only snowballing even further. So in crypto, technical analysis is so much more valuable than in other markets. And the reason that is when you're talking about stocks, you have a constant battle between investors and traders. people are looking for long-term, focused on fundamentals, and people that are looking in the short-term gains, right? And so in crypto, the fundamentals of Bitcoin aren't changing overnight. You don't have to worry about necessarily a scandal with a CEO or profits and earnings, them missing their quarter or anything like that. So the fundamentals are pretty fixed. Granted, they do change and they do grow as the entire space is growing. But for the most part, you end up seeing it trade with more of social psychology, in which case technical analysis is really just tracking patterns, right? It's tracking the patterns and the social psychology of the people that are trading that specific market. So what ends up happening now is technical analysis ends up almost becoming very, very valuable in the information that's being given. Me personally, when I trade for the most part, I less is more. I don't fill my charts up with a bunch of indicators and stuff like that. I use support, trend lines that I draw. I use volume, RSI, and then a personal indicator that I created that's focused around Keltner channels and then also Bollinger Bands. But for the most part, all the indicators that I'm looking for are things that are going to give me any kind of indication of what might follow and what could happen, but also very binary. You know, I trade on, you got to take emotions out of trading, right? You got to make it very almost if then. If this happens, then I do this, and stick to that trading plan. So the problem with a lot of indicators, though, is they're always hindsight 2020. You know, you have some moving averages that they keep moving based off of what's happening and everything that's happening after, right? They're late to the game. You know, of course, like I can't tell you how many times I've seen real time support. It looked like it's about to bounce off of a moving average, but then next thing you know, 15 minutes later, that moving average is a completely different place. And so everything I look at and everything I'm using, I don't want hindsight's 2020. I use stuff that's going to tell me what's going to happen and give me an idea. That way I can get ahead of it and prepare.